Okay, folks, here is a very simple one. Some application of ICT's SMC models. So what we have here, all of these buy side liquidities, all of these highs popping up here, and this highest high here, which is relatively equal to this one projected forward, that becomes your external range buy side liquidity. And you can see that price has been bullish all through this week. We intersected that specific high, and there is a little bit of price action here which we'll dive into to understand and see how we can possibly apply them if we see a similar scenario in the future. Actually, there are a lot of smart money concept techniques out there, different applications. There are so many ways to trade all of these, but this one is just a very simple model, and if you keep it as simple as this, you'll be able to find a consistent edge, knowing what to trade and knowing your setup whenever it forms. Now the external range high, we took out this buy side liquidity here. And what do you do now? Prior to taking out the liquidity, let us look at something very important. Now, this specific day of recording this video is Thursday, and this bearish candle here, this is the Thursday's candle. Now, statistically, from what we learned from ICT, high probability trending days are Monday, Tuesdays, and Wednesdays. So that means if you want to join a trend, let's say you anticipate bullishness for the course of the week, that means there is high probability that bullishness can be caught within Monday, Tuesday, Wednesday. Even that in the back of your mind, you know you do not want to go for continuation on a Thursday. Your high probability trending day is Monday, Tuesday, Wednesday, but Thursday it becomes low probability for the continuation. Otherwise, you should be looking for possible reversal or retracement scenarios on Thursdays. Now, having that in the back of my mind, I wouldn't be scanning this trade for buy setups anymore. Why? Because first, we've intersected the buy side liquidity, and from what you can see here, we've purged it a little bit. We did purge it to trade above the buy side liquidity, and today open trade above it again towards this move. Now, coupling it in your mind that today is Thursday, so it will likely see retracement or reversal because we are out of the high probability trending zone. Now, what should you do? So the moment to take out this buy side liquidity, the next thing you do is you drop to your lower time frame and see price reaction around that zone. Now, this is the point where we took out the buy side liquidity. Yeah. So you could see market trending, and we took out the buy side liquidity here. Let me zoom that a little bit. We took out the buy side liquidity, and you see this big impulsive sell candle. Now, this is something ICT taught in the 2022 mentorship model. So you want to see this impulse taking out a low. Fine. So which low was taken out there? Was this one. So fine. We took out the buy side liquidity, and price dropped impulsively, taking out this low. This is very important. You want to see the low impulsively being traded below. Very important. Now, after that, what do? You go for your displacement range from the section price displaced. So from this major high to this low. Now, look at this impulse. So when this price was trading down impulsively, it created displacement in price. Displacement in form of fair value gap here. So from this candle to the high of this specific candle, from this particular candle to the high of this specific candle, that is your fair value gap. Now, aside from looking at the fair value gap, you can decide to narrow it down to anticipating how deep price will trade into the fair value gap. Now, prior to the fair value gap, you could see this specific candle here, this one, this doji candle. You could see it delivered sell to this level and bought back before this fair value gap was created. So from this range up, that was an efficient delivery. Buys and sells reside there. Since that was efficiently delivered, it's not necessary for markets to trade back to fill this whole void. So it's just going to trade into the fair value gap and trade to where market was not efficiently delivered, and will continue the trend. Now, this becomes your major point of interest. So you can mark this whole point out because it's a point of interest. It's a point of interest. Or you can mark out the area where price was not efficiently delivered, which is from here to this low of this candle, and that becomes your point of interest. Now, Once price trades to your point of interest, what do you do? If you have a fair value gap this way, what do? You don't just place a sell limit order and start selling. Rather, you drop into your lower time frame and look for similar signature again. You look for either a fair value gap or an order block to trade off. Now, do not confuse yourself. There are lots of models out there: the breakout block, the order block, the this, the that. So you want to try as much as possible to stick to just a few. So in the course of this video, I'm going to be sticking with using just the fair value gap. Yeah. So what we're going to be doing right now, this is the buy side liquidity. We took it out. This is the change in the market structure, the shift in the market structure, market taking out this low impulsively, creating a fair value gap. So we have so many confluences now for a short trade. And what we're going to do now is to drop further into lower time frame, since price has traded into, hypothetically price has traded into our point of interest, which is this fair value gap this way. So you drop in between various time frames. So this is our section. You drop. Is there anything tangible here when price traded back for you to actually trade off? If you don't see anything, you still navigate in between the time frames. So prior to you taking a trade, you always want to see the willingness for price to react away from your point of interest. So if your point of interest is a sell point of interest, that means you want to see price actually reacting away from the zone toward the sell direction before you actually join in. So because you have this point as a point of interest, you're not just going to be placing a sell limit there. So check. So what we're literally doing right now is navigating in between various time frames, looking for entry signature for a sell. Now what we have here, this is the zone, the point of interest, and I took it down to 1 minute time frame. Is there any signature you can possibly see to frame your trade around, to frame a low risk trade and all of that? So this is the point of interest. You can see the gray box there, and this is the point you actually want to be watching the market, like you literally be on your chart looking for your signatures and all of those. Yeah. Now for one, you could see the shift in the market structure here, but that is not what we are focusing on. We're focusing on the displacement in price, which is the fair value gap. So after the shift in market structure created this lower low, the next thing we see here is this. You can see this small pocket of fair value gap and price tapping back into it. So this becomes your entry. This is a past trade now. You can go back in time to redo this, but this is a hypothetical situation that will guide you for when you see a similar setup in the future. Yeah, so this becomes your hypothetical entry, and you can see it's very small risk, and you can actually frame a trade around this. Now if you get this, what will you be targeting? You'll be targeting sell side liquidity. Now overall, this is a high time frame setup. From what we saw in the beginning of the video, we took all of these zones from the D1. So you want to target, still in this small time frame, you want to target sell side liquidity and then leave some partials to run, because this trade is actually a higher time frame trade. So fine, what you do next is you mark out your sell side liquidities. Yeah, we have a sell side liquidity here. This one, sell side liquidity. We have another one here, and all of those. Yeah. So now once you look at this trade, you can see that the risk is very minor. So assuming we got fill here 51.7 and stop loss above this high or above this swing high here, that's 51.6 in price movement. So you can see the risk is very tiny. Now the risk to reward ratio here should be very large. So this is you risking a few cents to make this whole range. You're risking just this small range of price action. This is the high of the fair value gap or the major swing high here. So you're risking this small range. So once you do this, make sure you take your partials. Yeah, take your partials. Once you get your fill, take your partials here, and you can set the trade to break even, or just leave it since you've taken out your partials. So let's say maybe you took out 50% or 80% or something. You still have trades to run to continue toward the direction of the high time frame trend. I hope this lesson makes you well, and it's a very simple application. So what you do is try to understand it and look forward for possible similar price signature in future markets, and see how you can apply this. So see you in the next video. Goodbye for now.